Imagine putting $20,000 into a savings account. You do everything right, you save consistently, you avoid unnecessary spending, you build an emergency fund, you feel responsible, you feel safe, you feel like you are finally making the smart financial move. And after an entire year, the bank pays you $76. That is it, $76. At first, that might not sound terrible. After all, the money was safe. It was sitting in the bank. It was available whenever you needed it. And the bank did pay you something. But then you discover something that changes the entire picture. While you earned $76, the bank may have used that same $20,000 to earn more than $1,000. The same money, the same year, the same deposit. You got the small piece. The bank kept the bigger piece. And suddenly, the question changes. The question is no longer, how much interest am I earning? The real question becomes, what is my bank doing with my money? Because your money was not just sitting there. It was not sleeping. It was not waiting quietly in a vault. Your money was working. The only problem is, it was working harder for the bank than it was working for you. And once you understand that, you may never look at a savings account the same way again. Most people think banks store money, but that is not really how banks make money. Banks do not become powerful by keeping your cash still. They become powerful by putting your cash to work. The moment you deposit money into a bank account, that money begins moving. It enters the banking system. It becomes part of a much larger machine. But here is the uncomfortable truth. Your money is not only working for you. In many cases, it is working much harder for them. Your deposit becomes fuel. Fuel for mortgages, fuel for auto loans, fuel for personal loans, fuel for credit cards, fuel for business lending, fuel for treasury investments. The bank takes the money sitting in customer accounts and uses it to create returns in other places. Then it pays depositors a tiny percentage, a small interest payment, a few dollars here, a few dollars there, just enough for most people to feel like their money is earning something. But somewhere else, the bank may be earning a much larger percentage from the same pool of money. And the difference between what the bank earns and what the bank pays you is where billions of dollars in profit can come from. That is the part most people never see. Because from the outside, a savings account looks simple. It looks safe. It looks like a place where money sits quietly. But in reality, your savings account is not a parking lot. It is inventory. The bank is renting your money from you at a very low price, then using that money in places where it can earn much more. That does not mean the bank is breaking the rules. That is the rule. That is the model. And most people never realize it because all they see is the small interest payment showing up every month. They see the deposit, they see the balance, they see the tiny interest. But they do not see what happens behind the curtain. They do not see where the money flows. They do not see who earns the larger return. And once you understand that, a savings account stops looking like a quiet place to store money and starts looking like one small part of a much bigger financial machine. Let's imagine someone named Maya. Maya is responsible. She is not reckless with money. She is not spending everything she earns. She is not chasing risky investments. She follows every traditional financial rule she was taught. Save money, avoid debt, build an emergency fund, keep your cash somewhere safe. So Maya saves $20,000. Not overnight, not by luck, but slowly, month after month, paycheck after paycheck. She makes sacrifices. She says no to things she could have bought. She keeps the money in a standard savings account, and emotionally, it feels like the right decision. She feels safe. She feels smart. She feels financially disciplined. Because from the outside, this looks responsible. The money is in the bank. The balance is stable. Nothing dramatic is happening. Then 12 months pass. And after an entire year of letting that money sit there, Maya earns almost nothing. A few dollars here, a few dollars there. Not enough to meaningfully change her life. Not enough to keep up with the real cost of time. But here is the part Maya never saw. While she was earning almost nothing, the bank may have used that same $20,000 to generate many times more. Her money was not asleep. It was not locked away in a quiet vault. It was moving. It was being used. It was helping the bank earn. And Maya only received a tiny piece of the result. But Maya is not losing because she is irresponsible. She is losing because she never asked one important question. What happens after the deposit? She assumed the bank was helping her grow wealth. But the bank's first responsibility is not to make Maya rich. The bank's first responsibility is to grow its own profits. That does not mean the bank is evil. That does not mean saving money is bad. That does not mean Maya made a foolish decision. It simply means this is the business model. The bank pays depositors a small amount, then uses those deposits to create a larger return somewhere else, and keeps the difference. Once you understand that, you begin to see savings accounts differently, not as a place where money grows, but as a place where your money may be working harder for someone else than it is working for you. Now meet Jordan. Jordan is not like Maya. He saw the problem earlier. He looked at the tiny interest from a standard savings account and realized something was wrong. So Jordan made a smarter move. He moved his money into a high-yield savings account. And immediately, the numbers looked better. Instead of earning almost nothing, Jordan started earning hundreds of dollars. Not just a few coins, not just a small monthly deposit that barely mattered, real money. Compared to Maya, Jordan looked like the winner. Maya was earning almost nothing. Jordan was earning much more. From the outside, it looked like he had solved the problem. And honestly, he had solved part of it. Moving from a standard savings account to a high-yield savings account is usually a better decision. It means your idle cash is working harder. It means the bank is giving you a larger share. It means you are no longer accepting the lowest possible return. So yes, compared to Maya, Jordan made progress. But then Jordan made one mistake. He thought the high-yield savings account was the finish line. He thought the problem was simply finding a better bank, a better rate, a better account. But that was not the full truth. Because behind the scenes, the bank was still doing exactly the same thing. The bank was still using deposits, still lending money, still buying assets, still collecting profits, still earning from the difference between what it makes and what it pays. Jordan was earning more than Maya, but the system had not changed. Only his seat inside the system had changed. He was still relying on the bank as the middleman. The only difference was that Jordan received a slightly larger piece of the pie, but the bank still kept the rest, and that is where the real lesson appears. The question is not just, can I find a better savings account? That is the beginner question. The deeper question is, do I need the middleman at all? Because once you start asking that, you stop thinking like someone shopping for interest rates, and you start thinking like someone trying to understand where the yield actually comes from. This is where things get interesting, because the bank is not only lending money, it may also be doing something much simpler, something many depositors could technically do themselves. Banks often take part of customer deposits and place that money into short-term government securities. In simple language, they buy government debt, they lend money to the government, and in return, they earn a yield. Then the bank turns around and pays depositors a lower yield. The bank keeps the difference. That difference may look small as a percentage, but across millions of customers and billions of dollars in deposits, it becomes enormous. And this is the moment most people never think about. If the bank can use your money to buy government securities, why couldn't you access those securities yourself? What if you did not have to stand behind the bank? What if you could get closer to the source of the yield? Because once you understand the underlying asset, the whole picture changes. Suddenly, the bank is no longer the only door. It is just one door. And maybe not always the best one. You are no longer forced to accept only what the bank decides to share with you. You can start asking, what is actually creating this return? And can I access that return more directly? That is the shift. You stop seeing a savings account as the final destination, and you begin seeing it as one layer between you and the real asset. For many investors, this realization changes everything because they discover there are options beyond traditional savings accounts, options that may be more transparent, options that may connect more directly to the source of the yield, options they never knew existed. And once you see those options, it becomes much harder to unsee the middleman. The biggest lesson from this story has nothing to do with savings accounts. It is not really about banks. It is not really about interest rates. And it is not even about finding one perfect financial product. The real lesson is about asking better questions. Because most people ask the surface level question. They ask, where can I get a higher yield? And that question is not wrong. It is just incomplete. Because a higher yield does not tell you the whole story. It does not tell you where the return comes from. It does not tell you who is taking a cut. It does not tell you what asset is underneath the product. That is why wealthy investors often ask a deeper question. They ask, what is creating the yield in the first place? That single question changes everything. It changes how you see money. It changes how you see investments. It changes how you see banks. It changes how you see every financial product placed in front of you. Because every financial product is built on something underneath. An asset, a loan, a bond, a business, a cash flow, a promise to pay. And between you and that underlying asset, there is often a middleman. Sometimes that middleman provides real value. Sometimes that middleman gives you convenience, safety, liquidity, simplicity. But every middleman takes a cut. Sometimes that cut is small. Sometimes it is reasonable. And sometimes it is enormous. So the next time you look at your savings account, do not only ask, how much interest am I receiving? Ask something much more important. What is my money doing while I am not looking? Where is the return actually coming from? Who is keeping the difference? And can I access that return more directly myself? Because the moment you start asking those questions, you stop thinking like a passive saver. You stop accepting whatever number is handed to you. You stop seeing financial products only from the surface, and you start thinking like an owner. Someone who wants to understand the engine. Someone who wants to know where the money flows. Someone who does not just ask, what am I being paid? But instead asks, what is my money really doing? And once you begin to think that way, you will never look at idle cash the same way again.